Well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B. We are in the spring 2022 semester. We are reaching our way toward the conclusion of the semester. We are in the last week of March, which means we have about 3 weeks left, roughly, of the semester after this week concludes. So, want to quickly point out where we are in the classroom, and then we'll jump into today's discussion on performance management and responsibility accounting. We are in Module 3, Week 11. Module 3, Week 11. So, one thing I want to point out, which is different about this week versus other weeks, is this one right here, the homework assignment. The homework assignment is designed to be short essay questions. Okay, it's worth 10 points, so it's worth more than your average homework assignment. Okay, so this is what it looks like right here. It's 5 questions, but they're short essay answers, right? So I'm looking for about a sentence or two for each question. Not Don't do any single words or anything like that. They have to be full sentences. Okay, so one or two full sentences for each question. That's how you'll answer the homework assignment. So one or two sentences for each question. And if you're pulling it directly from the book, make sure you put in some citations, just so I know where you got it from. And that's how you'll answer these 5 questions for the homework assignment. Now remember, it's worth 10 points instead of the standard 5. So make sure that you spend some time on completing this assignment. Okay. So one or two sentences per question, um, citations if needed, uh, and that should get you the full credit for each question. Each question is worth 2 points. So yeah, this one's a little bit more detailed than the other assignments have been. So that's my spiel on the homework assignment. That's due this Sunday night, so make sure that you get it in on time. Okay, so without further ado, let's jump into the discussion that will also help you in answering those 5 questions. But the discussion today is going to be on what we call responsibility accounting. It sounds easy. It's not as easy as you might think it is. And the reason for that is we look at this thing called responsibility centers. In accounting, it's not just one person that's doing the accounting work. It's not just the controller. It's not just the CFO. It's not just the CEO. It usually involves quite a few individuals, quite a few managers. As a manager, you know that you're responsible for what happens in your department. And if you're managing a department, you're responsible for everything that happens in that department. That also includes the accounting for that department. And so when we talk about responsibility centers, we're talking about departments. And when we're talking about performance management or measurement, we're talking about the performance of those departments. And so that's how I want you to think about today's discussion is try to departmentalize the approach. That'll help you to better understand it. So we'll talk about direct and indirect expenses and how they're allocated to departments. And I'll give you a couple of examples of how it worked for me in like the hotel business. And I'll also give you a couple of examples of how it worked in retail. Because I think that those two examples would be the most applicable to you to help you to better understand it. We'll talk about transfer pricing from transferring products from one store to another, maybe. I'll show you how that works and what that looks like. And we'll also talk about things like residual income, investment turnover, the balance scorecard, and a couple of other metrics for measuring performance. Performance is not just how well did the department do in terms of sales. That's not how, I mean, it's one method of measuring performance. The financial method of managing performance is how well do they do with their sales and manage their expenses and things like that. But we also look at things like customer service performance, things like the number of returns, things like hours worked, etc. All of those metrics are used in the evaluation of the performance for a company's division, segment, or department. You'll hear me use the word department a lot because I like to departmentalize when we talk about performance evaluation, especially in like a larger organization. There's two types of business organizations. One is called centralized, the other one is called decentralized. In a centralized organization, all of the decisions are made at the top level. The CEO, the CFO, the CIO, right? The C-suite employees, the board of directors. Those are all the folks making the decisions in a centralized organization. A centralized organization means like all the decisions are made at the top, right? That's a centralized organization. They use what we call the top-down approach to management. That everything, all the decisions are made at the top, and those decisions are then disseminated to lower level management, and then ultimately makes its way down to the frontline employees. That's called top-down. And that's how it works typically in a centralized organization. Centralized organizations are, it's pretty typical. An example of a centralized organization would be UDC. All the decisions are made at the president level and the president's cabinet, and then those decisions are disseminated through the chief academic officer and his office, and then the information is disseminated down to the department chairs and that or the deans, and then the department chairs, and then they make it their way to the faculty. So that's an example of a centralized organization. In a decentralized organization, decisions are made at the department manager level. I want you to think about the closeness the decisions are to the customer. The customer is closest to the frontline employees, right? It's like I'm a customer. I go into, we'll say, Best Buy or whatever, some type of store. I walk into a store. I walk into Best Buy, and I'm looking for a product, and I want to buy a product, and I don't know, which model to get or whatever. So I'll ask an employee, and the salesperson will help me to decide, right? And the store manager or department manager of that store might also help the customer, right? They might interact with the customer. Oh, how was your experience? What can we do to improve? That type of stuff, right? But this department manager oftentimes also interacts with the customer. They're the closest manager to the customer is the department manager in most cases. In decentralized organizations, oftentimes those department managers have the ability to make decisions on behalf of the store. for that customer, right? That's decentralized. It's decentralized because the department manager has the ability to make decisions. And that department manager is closest to the customer. So when decisions are made closer to the customer level, we call it a decentralized organization. Of course, they can't override corporate policy and things like that, but they can make certain decisions at the department level. And that's what we call a decentralized organization, where the lower level managers can make decisions rather than all the decisions being made at the top. And the reason why we're talking about this is because we have department managers that are responsible for the management of what I'm going to call, what do I want to call this? I want to call this responsibility centers. Responsibility centers. The department managers are responsible for responsibility centers. Each center is a part of a department. So think of a department, and then within the department you have centers, responsibilities. Just think of them as responsibilities. And these responsibilities include things like cost, profit, and investment. The department managers are typically always responsible for cost and profit of their departments. The department managers are responsible for the cost and the profit of their departments. So, as a store manager, above the department, as the store manager, I would evaluate my department manager based on their success of controlling costs and their success of generating revenue, sales, to create profit. That's how a store manager would evaluate a department manager's performance. It's based off of how well did they control their costs and how well did they generate revenue. That is the metrics that a store manager would use for a department manager. The department manager is responsible for the cost and profit centers within that department. There's a third center. It's called the investment center. Investments are typically reserved responsibilities for the store manager. Typically reserved responsibilities for the store manager, like the manager that manages the whole store. Because investments, as you know, are used to help the whole company to generate income. Property, plant, and equipment. We purchase property, plant, and equipment to help the business to generate income. We purchase property, plant, and equipment. We do that through investment. And so the investment center is typically the responsibility of the store manager, where they would make decisions on purchasing property, plant, and equipment to help the entire store to generate revenue. So these two centers, the cost and profit, the department manager. Investment center, it's typically the store manager, but they might also involve the department manager. Controlling costs in business is absolutely critical to the business's success. And for those of you who might own a catering business, or you might own a jewelry business, or you might own a screen printing business, talking about all of you, controlling your costs is absolutely critical to the success of your business. we need to control costs because ultimately, the more I have the ability to control my costs, the less affected I will be should something happen, right? So if a cost is controllable, the manager has the ability to affect the impact from that cost. An example, let's say I am managing a food and beverage department, okay? And in my food and beverage department, I have costs of the paper goods, I have costs of the parchment paper, I have costs of the food, the hot dogs, the hamburgers, the whatevers. And I also have the cost of the beverages, the soda, syrups, the cups, etc. Okay? As a manager, I have the ability to control those costs. How, you might ask? Well, I can limit the purchases of supplies. Like, for example, if I know that I'm not going to get a whole lot of customers on a particular weekend because of an event, then I'll say, you know what, I'm going to wait on purchasing those cups because I know I'm not going to get a whole lot of customers on that weekend. Or I might say, hey, you know what, I'm going to hold back on purchasing that additional roll of parchment paper. Or, hey, I'm going to hold back on purchasing those additional hot dog buns. Or whatever, right? But what I'm trying to tell you is, as a department manager, I have the ability to control certain costs, even labor, right? I could say, oh, you know what, I don't need 5 people on the line, this day because I'm not going to have enough customers, so I might only have 3. So I'll reduce my cost of labor for that weekend. Those are all controllable costs within your control, basically, right? That's good. It's like you want the manager to be able to control. You want to be able to control costs in your department. That's like super critical for success. There are some costs that the manager cannot control. Okay, so things that are outside of your control. If it's not controllable, that means the manager doesn't have an influence over that cost. So controllable, I can manage those costs. Uncontrollable, I cannot. That would be things like decisions that the executives made at the top. I can't control that. I can't control policy. I'm just a store manager, okay? I can't dictate what the return policy is. That's stuff made at the top level. I can't control those costs at the top level. I can't control the cost of what's happening with respect to salaries of other managers. I can't control that cost. It's not within my purview. The manager can't even control their own salary because their salary was dictated by the managers above them. Okay? So it's like if you're a department manager, the store manager assigned your salary. You didn't assign your own salary, right? So even the manager's own salary is not a controllable cost for the department. So just remember, controllable means I can influence, I can control those costs. Uncontrollable are things outside of my purview. I can't set my own salary for the department. All this information related to cost, which is what this whole course has been about, really, is stored in this thing called an accounting information system. Accounting information system helps us to track our costs. We've talked about this a little bit before. The accounting information system is like QuickBooks, Oracle, Sage, M3, whatever. It's an accounting system. It's a database. It tracks all the information, helps us to generate the financial statements, etc. Within that system, I also have what's called responsibility systems, and it provides information related to the responsibilities of the individual managers, such as the sales and costs of each department. And that information is used to evaluate the manager's performance of controllable costs. So the accounting information system tracks the sales and costs of each department. And the sales and costs of each department are considered to be controllable costs. And so, or controllable items. And so that information is used in the evaluation of the manager's performance. Within responsibility accounting, it's the responsibility of the entire organization working together. We can see this through this organizational chart. With this organizational chart, the company has the board of directors, they elect the president has a couple vice presidents, and then each vice president has different managers. You could probably say that this is probably a hotel, actually. A hotel company might have this type of organization. One that comes to mind would probably be Marriott. They would probably have this type of organization structure. The reason why I say that is because the vast majority of Marriott hotels, as you probably know, are corporately run. And because of that, there is a lot of influence. And so I can see that they would have this type of structure. So let's say this is Marriott. Okay? So Marriott has a board of directors, they have a president, and they have a bunch of vice presidents who are responsible for the different regions of the planet. So, for example, the vice president that's responsible for the United States has two vice presidents underneath that president that is responsible for each region in the United States. And within each region, there are managers that are responsible for the different departments within the hotels. So, beverage department, food department, service department. And some organizations is probably broken out even more than that, but this is just an example. But this goes to show you the different levels of responsibility and how the entire organization is ultimately responsible. The performance is measured based off of the responsibilities. We measure performance through sales and managing costs. Those are like the two primary ways we measure the performance of any manager: sales and how well do you manage your costs through the profit and cost centers, right? Yeah, I mean, that's really that's the real way we measure the performance is through the sales and how well they manage their costs. But of course, we also look at other metrics like guest or customer satisfaction, employee satisfaction, employee training, research and development. There's a couple of other metrics that we would use within the balanced scorecard. to evaluate the performance. But department manager typically will receive like a detailed report on how well they did, how well they managed their revenue and expenses. And a store manager will receive a summary for each department. So each department manager gets their report usually at the beginning of the next month for the previous month. Oh, hey, all right, so how well did I do in February? Oh, okay, my sales were X, my costs were X. These costs I can control. These ones I cannot. And so you're evaluated based off of the performance of the ones that you can control. The store manager receives a summary of all of those department reports to kind of get an understanding of how well the whole store did in terms of performance. So here's an example of that. So think of it as we call this a roll-up report. So it starts at the bottom. Everything starts with the department and how well the department managed their controllable costs. Remember, controllable costs are the costs that are within the purview of the manager that they can actually control. It includes things like direct labor, direct materials, factory overhead. We can control those, and we can evaluate how well the department performed by comparing the budget to the actual performance. Now, based off of this information for the month of July for the beverage department, I can compare the actual amount, the budgeted amounts for each line item. And I can see based off of this information, I'm a little over on direct materials. Actually, I'm a lot over on direct materials. I'm under on labor, I'm under on overhead. And based off of these differences, I'm over the total budgeted amount by $300. Being over budget can be, it could not be good, right? You can get in trouble for being over budget on certain things. We don't know what the sales were. If the sales were also higher, that might not be as bad. But since we don't know what that was, based off of the cost, I'd say, oh, this manager might get in trouble, being 300 over the actual budget. So what happens is the vice president of the region will receive all of the department reports, right? And so for the beverage department manager, we can see how they compare to the food department, service department. And in looking at this, the beverage department manager might be in a little bit of trouble, right? But the vice president level, they're gathering all of the individual reports and they're compiling them. And then that gets rolled up again based off of the region as a whole, and that's compared to the other regions and the other controllable costs within the president's office. Everyone kind of understands how it works. You're all still good, right?
Yes, we're still good.
All right, cool.
Can I ask you a question though, Professor?
Ms. Rhodes, go ahead.
Okay, now you say, I understand the part when they were saying that you like going over budget. Well, yeah, over budget, that they can get in trouble because when we was doing the budget at the stadium one season, and when the chef came to our kitchen to look at our inventory sheet and all that, and when he looked at it, he was wondering why do we have so much extra product than what we supposed to, because he said we're supposed to be down to a certain amount at that time.
Right.
And he said that what we started doing was we can transfer a product to another kitchen to lower, to bring ours down to what it's supposed to be at that time. So the chef, that's what the chef say. He said, "Y'all trying to get me in trouble."
Yeah, yeah, no kidding. Yeah, that's so true. Because the chef has to answer typically to the food department manager,
Yes.
and that food department manager probably has to answer to like the corporate office or whatever. And
Yes.
so,
Yep.
and so the trouble trickles up the line. You know what I mean? So, but yeah, your example is correct, and that's actually exactly why that happens. And so, and I'm glad that you brought up the discussion on transferring, and because we're going to talk about that here shortly. So, one of the responsibilities comes from the concept of, when it comes to managing the cost, also comes from understanding the expenses, right? We have expenses that are both direct and indirect. Direct expenses are expenses that belong to that department. I can trace those expenses directly to that department. Like department wages, uh, the square foot of the department for rent. I can allocate the utilities used by that department. If there was a special advertisement that ran for that department, I can allocate depreciation to the department based off of the assets used in that department. Those are things I can trace. So remember that we had a discussion a long time ago, probably 10 weeks ago, to be exact. We talked about direct and indirect costs. It was a long time ago, right? But direct costs are costs that I can track directly to the cost of the product, right? It works the same way with direct expenses, the costs I can track directly to the department. Indirect expenses I cannot directly trace because they're considered joint costs. Joint costs are costs that are shared in between other departments. They do not belong to one specific department. An example of that would be the store manager's salary. The store manager is responsible for all the departments, not just one. So I cannot attribute the store manager's salary to any single department. Because of that, it's considered an indirect expense. Another example would be of indirect expense would be the accounting office expenses or human resources expenses. I can't trace those costs to any specific department because they are indirectly responsible for the whole store. So those are indirect expenses. So direct expenses would be things like the department manager's salary, all the employees that work in the department, rent for the department based off the square foot, utilities for the department based off the square foot, any specific advertising, depreciation used by the department. Those are direct expenses. Indirect are things that are shared across the entire store or the entire company. We allocate costs based off of a formula. The formula for cost allocation is the total cost to allocate times the percentage of the allocation base used. Oh, I know that one sounds harsh, right? Let me break it down a little bit further. When we're allocating a cost, it's based off of its usage. So, for example, let's say I'm the jewelry department manager at Macy's. Okay, I'm the jewelry department manager at Macy's, and I have a 200 square foot department. That's the size of my jewelry department, about 200 square feet. It's all the space, inside where the cases of jewelry are, and it's the space inside. It's also the space of the jewelry display cases. So that is the allocation base I'll use, is the square footage of the jewelry department. So 200 square feet would be my allocation base. And the total cost I would allocate to that allocation base, the total cost I'll allocate is, we'll say, the cost of labor for the department. That would be my allocated cost. For indirect expenses, we would allocate costs the same way, but it's based off of the total percentage of the allocation base. So, for example, in my Macy's example, I'm the jewelry department manager, and my jewelry department is 200 square feet. The whole store is 50,000 square feet. Okay? So we would find the percentage of the allocation base. We'd take the 200 square feet divided by the 50,000 square feet to get the percentage used. And then we would multiply that by, we'll say, the store manager's salary. That's an indirect expense. Store manager salary times 200 divided by 50,000 would get me the allocated cost of the manager's salary to my department. That's how we allocate indirect expenses equally to each department. Does that make sense? Yeah,
Yes.
right.
Yes.
Yeah, that's an interesting concept. So I just want to make sure that you all understood it, because allocating indirect expenses can sometimes be complicated. But just remember that we take the total cost of the indirect expense, and we multiply that by the percentage of the base used. The percentage of the base used is oftentimes derived through square footage. So the square foot of the department divided by the square foot of the store equals the percent of the allocation used. And then we multiply that by the store manager's salary to allocate the correct proportion of the manager's salary to the department. It's the best way I can describe it. It's basically like a fair way of allocating indirect expenses. Because you don't want to say, oh, it's all that one department. That's not fair. Because the store manager is responsible for all the departments. Okay, so yeah, here are the bases that we would typically use when it comes to allocating indirect expenses. This one's for service. So I had mentioned earlier that we have indirect expenses that come from other departments. Examples would be like human resources, the accounting office, the store office. Their expenses need to be allocated. And we would allocate based off of the allocation base that is commonly used. For example, the office personnel, the office employees. The allocation base is the number of employees in each department. That's how we would allocate that expense. Personnel expenses, number of employees in each department. Payroll expenses, number of employees in each department. purchasing costs. Based on the dollar amount of purchases or the number of purchases, purchase orders processed, and we divide that equally. Maintenance expenses divided by the square footage occupied by each department. So earlier I gave you the example of I'm the Macy's jewelry department manager. So as the Macy's jewelry department manager, the store will allocate the maintenance expense to my department based off of my square footage, which is a fair way of doing it. So that's how we would allocate indirect expenses from our service departments. Remember, service departments are those are like the support departments, right? It's like, because they don't generate revenue, like the office is not generating revenue. The accounting office, the human resources, maintenance, all of those are support offices, right? They support the operation. They don't generate revenue. Because they don't generate revenue, we call those expense centers. And those expense centers help to operate the business. And so we need to allocate their expenses to the departments according to the allocation basis. Here's an example of our, this one's a jewelry store, okay? This one's a jewelry store. So let's say we have a jewelry store. And within our jewelry store, we have a jewelry department, a watch repair department, and we also sell china and silver for whatever reason. And so we need to allocate indirect expenses to those departments. And we do that with the base of square feet. The entire store is 4,000 square feet. And I have square foot for each department. 2,400 for jewelry, 600 for watch repair, 1,000 for china and silver. Those are the square feet of each department within my jewelry store. So we can express that as percentages, right? So 2,400 divided by 4,000, that's 60% of the total square feet of my store. 600 divided by 4,000, that's 15% of my total store square foot. 1,000 divided by 4,000, that's 25% of my total square foot of my store. So we take the cost, the indirect cost, the total indirect cost, and we multiply that by the percentage allocation base. That's the formula, right, for allocating indirect expenses. We take the total cost, total indirect cost, times the percentage of the allocation base. In this case, it's the square foot percentage. So $800 is the total cost per month. And so I take the $800 of indirect cost, janitorial services, $800 times the allocation percentage. 60% of 800 is 480. So I would allocate $480 of janitorial services to the jewelry department. $800 times 15% is $120. So $120 of janitorial services will be allocated to the watch department. And the china and silver, we take $800 times 25%, that's $200. So $200 will be allocated to the China and Silver department. Everyone understand how we allocate indirect expenses to departments?
Yes, but I have a question.
Yes, ma'am, please.
So I do understand your example, but in a broader spectrum in theory, the more important departments will be bigger in square footage than a smaller support department, right?
Typically, yeah. I mean, it depends, really. I've seen some store operations where the largest, like for example, let's say we could even use this example. The watch repair department might generate more sales than selling jewelry. You know what I mean? Like, let's say they're just really good at watch repair, but they also sell jewelry. The jewelry takes up most of the square footage. It doesn't always mean that's the department that sells the most. You know what I mean? So, like, in some cases, the department that makes the most amount of revenue for the store might be the smaller of all of the departments. So I would say, to answer your question, in most cases, yes. Like the larger square foot is allocated to departments that make the most amount of revenue. That's why if you go into like a Kohl's or a Macy's or any type of retailer, the women's department is always substantially larger than the men's department when it comes to clothing, right? That's just fact. Uh, you know, why is that? The vast majority of customers are just so happen to be women. So that's how a lot of retailers decide on square footage. You know, it's like, okay, well, I'm going to give more square footage to the departments that typically make the most revenue, which is in most cases true. But there might be the occasional retailer where the smaller department is actually the breadwinner of the company. You know what I mean? So to answer your question, in most cases, yes. But there might be those few cases where that might not be true.
Got it. Thank you.
Cool. You're very welcome. So when we've done our allocations of indirect expenses to the various departments, we can generate our income statements for each department. A department's income statement will be very similar in nature to the store's income statement. It'll have sales, and it'll have uh, sales minus cost of goods sold equals gross profit minus your expenses equals net income, right? It's the same setup for each department. We'll have our sales, but then we'll probably break it out by, when we get down to the expenses, we'll break it out by direct expenses and indirect expenses. Okay. So direct expenses, indirect expenses will be like the subcategories under expenses. That's how we break it out by department. It just makes it easier to read. And so we follow these 4 steps, okay, to create the income statement for each department. Take our revenues and our direct expenses and our indirect expenses. We allocate the indirect expenses to both service and operating departments because, as you know, indirect expenses get allocated across all departments equally based on the percentage base used, which is usually like square footage or whatever. And we allocate service department expenses to the operating departments. That would be like, that's like saying I need to allocate human resources and the accounting office and the back office expenses to the departments based off of the allocation base used, and then I can prepare the income statement. This is what the income statement for a department would look like. So we have, so this is for the whole department. This example is the hardware department. We'll say, well, I would say Sears, but yeah, they're kind of gone. So I'll say, I don't even know who has hardware anymore. Okay, so this is a department. We have our revenue and our expenses, and we also have the allocations. So sales is our revenue, and the revenue is broken out by 3 operating departments within the department, 3 operating areas within the department. No, we can say this. Oh, okay. This is a hardware store. This is a hardware store, A1 Hardware. And we have 3 departments within the store. We have hardware, housewares, and appliances. Our hardware department, housewares, and appliances all have different amounts of sales, which means they'll have different amounts of cost of goods sold. They all have salaries of the different employees that work in each department. They all have depreciation based off of the equipment used in each department. And they all have supplies. Now, I have additional salaries, depreciation, and supplies for the general office and the accounting departments, or accounting office. So I have salaries in accounting and in general office. I have depreciation in accounting and general office, and I also have supplies in accounting and general. And I also have my indirect expenses. I got rent, utilities, advertising, insurance. Remember, indirect expenses I cannot directly trace to any individual department, so I need to allocate them to all of the departments equally by using the allocation base for each department, which is typically square footage. So step 1 is we have identified all of our expenses. Step 2 and 3, step 2, I'm going to allocate my indirect expenses to the departments based off of the allocation base. The allocation base for rent is based off of the amount and value of the space, square footage. Utilities based off of square footage. Advertising expenses based on sales. And insurance based off of value of the assets insured. Makes sense. So what I've done is I have taken the amounts for rent, utilities, advertising, and insurance and allocated those indirect expenses to the hardware department, housewares department, and appliances department based on the allocation basis. So that's step 2. Step 3 is I'm allocating the service department expenses to the departments for the store. Remember, the service departments are departments that help to support the store operations but do not generate revenue. That would be things like human resources, accounting, and general office. And so I need to allocate those to the departments. And for the general office department expenses, I allocated based off the amount of sales. That's my base. And then for the purchase department, it's based off the number of purchase orders. And so that's how I allocated those expenses. And then step 4, I can prepare my income statements for each department and for the entire store. So under the combined section, that's for the whole store. But then you can also see what it is for each department. Contribution. We had a discussion some time ago on this thing called the contribution margin. Remember? Contribution margin is the sales amount minus the variable cost. That gives us the contribution margin per unit. Sales amount minus the value, I'm sorry, the sales amount minus the variable cost gives us the contribution margin per unit. Remember that we talked about that, I don't know, probably 5 weeks ago, 6 weeks ago. And so this is very similar, but this is the contribution to overhead. Okay, so but it works kind of the same way as contribution margin did. So with this, we're taking the department's revenue minus the direct expenses equals the department contribution to overhead. So department revenue minus department direct expenses equals the department contribution to overhead. We use this to help to evaluate the department's performance. That's really the best use for it, right? It helps us to evaluate the department's performance. And remember, department performance is based off of how well did the department manage and control their controllable costs, their controllable expenses, and their revenue, of course. The contributions to overhead can be allocated to the income statement for each department based off of taking the sales for the department minus the total direct expenses. I'm sorry, gross profit minus the total direct expenses. So we talked about the revenue center. We talked about the cost center. And we talked about how the department managers are responsible for managing their controllable costs and their controllable revenue. And so since we talked about those, the last responsibility center that we need to talk about is from investments. Remember, in business, when we talk about investments, we're talking about the purchase or sale of property, plant, and equipment that's used to help the business to generate revenue. Oftentimes, these investments are managed through like the store manager, right? Of course, they collaborate with the department managers, but oftentimes the investment centers are made through the store manager because those investments oftentimes impact multiple departments. So the performance measures for the investment centers are things like return on investment, residual income, the profit margin, and investment turnover. These are all formulas, okay? These formulas are used to help the managers that are responsible for the investment centers to understand how well they're utilizing their investments into property, plant, and equipment to efficiently manage the business and to generate revenue. So the first formula used in the investment center, I'm trying to say, management or control is what we call the return on investment. The return on investment is used by taking the revenue, also known as investment center income. So revenue divided by average invested assets. Revenue divided by average invested assets. Average invested assets, beginning balance plus the ending balance divided by 2 for your fixed assets, property, plant, and equipment. So here we have an example. This example, we'll say, is for, I don't know, Best Buy or whatever, some type of electronics store. And the electronics store, I have two divisions. I have TVs and I have phones. And so in my electronics store, I have TVs and phones. TVs are LCDs and phones are S phones. I'm not going to call my phones because, that's like copyright infringement. Okay, so LCD TVs. We have income from the sales of the TVs, and we have the average invested assets. Remember, when you hear the word average, oftentimes it's beginning balance plus ending balance divided by 2. You get the average. So the formula is the income for the respective department or whatever, divided by the average invested assets. For televisions, my return on the investment is 21%. For the phones, it's 23%. Both of which, by the way, is very good. Very good. But what does it tell us, right? What does it tell us? The higher the ROI, return on investment, obviously is the better, right? Return on investment, the higher percentage is best. What this tells me is that I am more efficient at using my assets to generate revenue for my phones more so than I am my televisions. And so as a manager, I might want to say, hey, maybe I should look at what's going on in the TV department. Why is my ROI not as high as my phone department? And that's one of the uses of ROI. The next formula for the investment center is called residual income. This one's very straightforward. Residual income is the additional income that I would generate from an additional unit of sales. Okay? That's what it means, residual. It's income from an additional unit of sale. So the formula here is I take the net income minus the target net income. Now remember, a few weeks ago, we had a conversation on break-even analysis. Remember? We talked about cost, volume, profit. I will say that was chapter 21, if I'm not mistaken, so it was just before the midterm exam. We talked about cost, volume, profit analysis, and we talked about this thing called target income, right? When we talked about break-even. That was one of the methods, remember? Yeah, it was a while ago, I know. So what we did there is we took the desired net income minus the target investment, or target income. And this formula kind of works the same way. Remember, the target net income that's the desired net income. That's what we want. We want it to be that much. So using our formula, we take the net income for each division or each department minus the target income for each division or department to get the investment residual income. And so in this example, the target income is 8% of division assets. That's how we found the target income. So all you do is you take the 8% times the division assets for each division. Pretty straightforward. And then, of course, profit margin. One of my favorite ones is profit margin, right? Profit margin, as you recall, is income divided by sales. Profit margin is income divided by sales. Pretty straightforward. The profit margin, income divided by sales, or net income divided by sales, shows us the average profit for each department or each division, okay, in a company. Wonderful way of measuring the company's ability to generate a profit. And that's why in the investment center, we look at the profit margin. And we also look at this thing called investment turnover. The investment turnover tells me how well I am utilizing my assets to generate additional sales. Okay? And so the investment turnover is sales divided by average total assets. Sales divided by average total assets. And so what that does is it shows me how well I'm using my assets to generate sales and also my profit margin. If I multiply my profit margin formula times my investment turnover formula, I can find the total return on investment. So yeah, that's how that works. And again, it's very useful for a manager because it really does tell us how well we're using our assets to generate revenue. Everyone kind of understands how all that works, right? All right, cool. Let's go ahead and talk about the balanced scorecard next. The balanced scorecard. Oh man, I like this one. This is a great concept. In business, it's not just about the money. I mean, it's a big part. Yeah, the money is a huge part. You know, revenue, expenses, that's a big part of business. But it's not everything. The finances isn't everything. In business, we look at several different metrics to understand how well the business is performing. And we do that through this concept called the balanced scorecard. The balanced scorecard measures a couple of different metrics to show me how well I'm doing, right? So there's like four categories that I want to look at as a manager. One is the customers. I also want to look at internal processes, research and development, and the finances. But I want to look at all four of those areas together to get the whole picture, right? Because we know the finances, we got that down. Net income, return on investment, sales growth, cash flows, residual income, the stock price. Those are all metrics to tell me how well the company's doing financially. Don't get me wrong, that's great information, but that's not the whole picture. I also want to look at things like how satisfied my customers are, how many new customers came in the door, the percentage of on-time deliveries, percentage of sales of new products, how long it took me to fill the customer's order, and the percentage of the sales that came back as a result of like defect or customer returns based off of whatever other reason. But that's all data that I can get from my customers to tell me how well I'm doing it with respect to sales, but also tells me what I call the throughput. Throughput is really important because uh, it's not just about the sales to the customer, it's about how well the company did servicing the sales to the customer. Uh, the throughput, right? It's not just the sale, it's the follow through after the sale. Following up with the customer saying, oh, how was your experience? Blah, blah, blah. How long did it take? All of that data also helps the company to determine what their future sales might look like. Because remember, in business, and you all know this, right? I don't go out to eat somewhere or shop at a place if their ratings are bad. If their customer reviews are bad, I'm probably not going to go there. All right. Usually the first thing I do before I go to any new place that I haven't been to, I read the customer reviews. That tells me what I'm in store for. Right? So that oftentimes that makes my decision whether to go there or not. The other thing we look at as a whole for the business is our internal processes. Things like defect rate, cycle time, product cost, labor hours per order, production days without an accident, etc. That information helps me to streamline my operation. A few weeks ago, we talked about this thing called just-in-time manufacturing. We also talked about the physical flow of inventory. We also talked about the physical flow of processing way back when we talked about process costing. We also talked about internal processes when we talked about process costing and a couple of other ways that we track the inventory. Streamlining your internal processes really does help the business overall. And then lastly, we also look at this thing called research and development, also known as innovation and learning. This measures things like employee satisfaction, employee turnover, the amount of money we spend on training, the number of new products that have been developed, the number of new patents that have been developed, and the amount of money we're spending on research and development. And all of those things together on a single report is called the balanced scorecard. And that is the most efficient way to manage the entire business using all of the data available. Now, this brings me to the next part of our discussion, and Ms. Rhodes has actually brought this up when we were talking about managing our food cost. And, when the chef comes down and says, oh, we got a lot of product sitting here, instead of letting it sit here, let's transfer it to another outlet, right? So we're going to take it from the food from the unused material, unused food, from this venue and transfer it to another venue. And so that works through this process called transfer pricing. In most organizations, it costs something to move the product from one department or location to another, right? We call that transfer pricing. And it works in a couple of different ways. Usually what happens is that the two managers get together and they negotiate a deal to transfer the inventory from one location to another. Okay, and that's exactly what we're going to talk about right now. And so in the transfer process, oftentimes the managers negotiate a deal to transfer the inventory from one location to another, and who covers that cost? So the transfer price is the amount charged when there's that type of exchange of goods or services from one division to another. And so in this example, in our electronics example, we have the television division wants to transfer displays that has available to the phone division. And so in that, we look at information like the production capacity for the TV division, the sales price, the variable cost per unit, and the total fixed manufacturing costs. That will give us an idea of the ability to transfer the LCDs displays from the TV division to the phone division. So, Ms. Rhodes, from that example, your earlier example in conversation with your chef at your place of employment, when that type of thing comes up, oftentimes the chef has to get involved with the food manager and say, okay, well, if I'm going to move this from my location to another location, here are the costs, here's the capacity, and here's what those costs need to be transferred, right? And that's where the transfer pricing comes into play.
Okay.
Yep. So
I understand that.
it's the stuff that happens on the back end, you know. A couple of other things you need to understand as it relates to understanding the transfers and with respect to understanding how well the managers are managing the revenue center, the expense center, and the investment centers is through this concept called the cash conversion cycle. This tells me how quickly I am converting my accounts receivable and inventory into cash, right? And so the formula for that is pretty straightforward. It's a pain in the butt to calculate, but it's pretty straightforward. Remember, just do one at a time, plug in the values. First is called, we take the days sales and accounts receivable plus the days sales and inventory minus the days sales and accounts payable. Each of those are individual formulas that we do first. So days sales and accounts receivable is accounts receivable divided by sales times 365. That's the number of days. Days sales and inventory is inventory divided by cost of goods sold times 365. Days sales accounts payable divided by cost of goods sold equals times 365. Once you get the results for all three of those formulas, you just plug them in. And that will give you your cash conversion cycle. How quickly I'm converting into cash. Or how quickly I'm converting into cash, exactly. And that's an important thing to understand because how quickly you're converting into cash tells me how soon I could get cash into the business to then make further investments, right? And that's why it's important to understand how long it's taking me. And as a manager, especially if I'm like managing the assets of the company, I would want to understand these days to then figure out ways to improve them. So just to kind of recap, and this was one of the most important parts of our discussion that we had earlier. It's on the cost allocation. So especially for indirect costs, Remember that the formula is the total cost to allocate times the percentage of the allocation base used. And oftentimes the percentage of the allocation base used could be based on something like square foot of the respective department. So square foot, dollar value, sales dollars, number of purchase orders, these are the allocation bases from our earlier example of how we allocated indirect costs. And costs from other departments, remember? Yeah. You know, rent works really the same way. Oftentimes rent is the easiest indirect expense to allocate because it's based off of the square footage for each department. Square foot times a percent allocation equals the total allocated cost. Very straightforward. Utilities, you know, utilities oftentimes is also done by square footage. And the reason for that is pretty simple. You have a certain number of lights in each department. I mean, they're all connected to the same, you know, system, the same light system, but we allocate it based off of square footage because it's the easiest way to do it. Advertising is typically allocated based off of sales dollars. So it's like, oh, I sold this amount. Well, you can take this percentage of the advertising expense. Insurance is oftentimes based off of the value of the assets within that department. And that's how we allocate the insurance expenses. And then, of course, service departments is based off of their respective allocation bases. For each department, it could be based off of sales, it could be based off of number of purchase orders, etc. We're just recapping now. We talked about transfer pricing. Again, oftentimes it's just a negotiation between the two different department managers on what the transfer price will be. But it's based off of the data, right? So it's like, okay, well, the sales price is $80, variable cost is $40 for manufacturing. Well, sometimes they might agree to pay the difference in the transfer price. Yeah, so if the sales price is 80, the variable cost is 40, they might agree to pay $40. Or if the sales price is or let's say that the total cost of manufacturing is $80, then the transfer price will be $80. But the transfer price will never exceed the total cost of manufacturing. But oftentimes it's somewhere in between the variable cost and the total cost of manufacturing, or the total sales price. And then this last concept I wanted to talk about is called joint costs. Joint costs are costs that are shared across all departments. Also, it's important to know that the cost of a single product may also share costs. And so we call it as joint costs. This is an example of joint costs and the allocation based off of the utilization. Not something you need to go too deep into. It's more for like an advanced accounting course. And that, my friends, is the end of our discussion today on performance measurement and responsibility accounting. Are there any comments, questions, concerns that I can help answer at this time? We all good? You all eating? All right. Okay. Just to kind of.
We good. We good.
You're good. All right, cool. Just to kind of recap one last time, in the classroom, week 11, chapter 24 is what we just talked about. The assignment is different for this chapter than it has been for others. It's short essay questions. There's a total of 5 questions. I'm looking for 1 or 2 sentences for each question. Very short, easy, simple, 1 or 2 sentences. Sentences, not words. Sentences, not words. 1 or 2 full sentences for each question. Include a citation if you need to. And that should help you to get full points on each question. Now, the other thing to note is this is worth 10 points instead of 5 because it's essay based, right? So short essays. I'm just looking for 1 or 2 sentences for each question. That's all. And that'll help you to answer the homework assignment. Okay, so if there are no other questions, comments, or concerns, remember, you can always email me, call me, set up office hours. Office hour link is right here. It's real easy. You just click on it. We also have tutoring available if you need tutoring for whatever reason. We have Professor Remy for the tutoring. You have me for the office hours. You can also email me, whatever you need. You know, I'm always here for you. So anyway, having said that, please remember to stay safe. Wash your hands. Do the right things. And I'll see you all again, same time, same channel, next week. Thank you all so much for your time today. Appreciate all of you. Have a wonderful, wonderful day.